Rivian was one of the hottest up-and-coming electric car brands of the last decade, but things have not been going so well for them recently. After losing $2 billion in 2023, California-based Rivian lays off hundreds of workers. We'll get into why Rivian is struggling overall, but as for this specific layoff, this is the reason. The layoff announcement came alongside Rivian's financial results report for the end of 2023. Despite the buzz surrounding the luxury car company, Rivian lost more than $2 billion last year on $4.4 billion in revenue per the report. Our business is facing a challenging macroeconomic environment, including historically high interest rates and geopolitical uncertainty, and we need to make purposeful changes now to ensure our promising future, CEO RJ Scaringe said in an email announcing the layoff to staff, according to Porter. Now, I do want to point something out here. Challenging macroeconomic environments, historically high interest rates, geopolitical uncertainty, these are all buzzwords that every CEO having to make hard decisions will use, and they basically don't mean anything. And not only do they not mean anything, but they're also completely wrong. And because we want to look at the real reasons Rivian is not doing well, we first have to debunk the CEO's reasons, which are what he outlined here. So first thing we're going to look at, challenging macroeconomic environment. We can debunk this pretty easily by just looking at the S&P 500, which over the past year is up nearly 30%. Now, the stock market is not equivalent to the economy. I totally understand that, but it is generally a good indication of how the economy is doing overall. Now, there are going to be a lot of people that point out that despite the fact that the stock market appears to be doing well, there's still a lot of inflation, and that is absolutely legitimate, but I don't think that's actually impacting Rivian, because if you look at their website, their cars are really very expensive. They're close to $100,000 per car. The same class of people that are purchasing these cars are probably not impacted by things like inflation as much as the middle or lower class are. These are luxury electric vehicles for people that have $100,000 to blow on a car. The next thing he says is historically high interest rates. And that is actually simply and verifiably not true. They have been higher recently, but if we look over the last 30 years of interest mortgage rates in the average United States, which isn't equivalent to the same rates that the federal government or banks use when giving out loans, but they do tend to be very similar. We can see that they're higher than they have been recently, but they're really overall on a very downward trend. It's only in the past couple of years that they've actually gone back up. These are not historical high interest rates. These are interest rates that are higher than they were a couple years ago, but on average are far, far, far lower than we've seen over the past few decades. And the final thing he says that is causing his company not to go particularly well is geopolitical uncertainty. And geopolitical uncertainty could be referencing two things. Could be the Russia invasion of Ukraine, or it could be the Israeli invasion of the Gaza Strip. And we can look at each of those to see if either of them have any validity. And spoilers up front, they do not. Russia invaded Ukraine in 2022. Now, there were conflicts in 2014 with the annexation of Crimea, but the main invasion that we're talking about right now in the news recently happened in 2022. And as you can see, the stocks were already tanking significantly by the time the invasion actually happened. So that is not having any impact on Rivian's ability to be profitable. The second geopolitical uncertainty we could talk about is the Israeli invasion of the Gaza Strip. And what impact might that have? I don't really know. I was looking into this trying to figure it out. So I'm looking at the electric vehicle market in Israel. And from what I can tell, it's really very tiny. There's maybe 35,000 vehicles sold. But then if you look at the actual companies that are making the vehicles that are being purchased in Israel, Rivian is not on here. There's Geometry, there's Tesla, there's a couple of other like Hyundai, Kia brands you might recognize. Rivian is probably somewhere in this 15% of other category. There's no world in which the conflict in Israel and Gaza is causing Rivian's sales to go down by any meaningful amount, at least. So now that you know that the CEO's reasons are bull, we can talk about why Rivian is actually failing, and also additionally we'll get into why the entire EV market as a whole is kind of facing difficult times. And the first thing we have to do is talk about how Rivian was really overhyped. And I know it is the most cliche thing in the world to say that a new up-and-coming company that is now doing badly was overhyped, but bear with me here. Look at this. Rival electric manufacturer Rivian is currently worth an incredible $41 billion, which is not anywhere near Tesla, but it actually is almost identical to Ferrari, which seems reasonable until you realize that the company has made just 920 cars last year. Not 9,200 or 920,000, just 920 cars. It is hoping to build 25,000 cars in 2022. So in all of 2021, a company that was worth something like $90 billion at its peak only produced 920 cars. So I think it's safe to say that it was awfully overhyped. Investors gave tens of billions of dollars to a company that had not proven that it could do what it actually said that it would do, and this almost immediately caused issues as Rivian started missing production goals essentially right out the gate. And because of that and other reasons, in the first 6 months, its stock tanked by 75%, while Rivian stock has plunged 75% in the first half of 2022. One of the biggest reasons Rivian's initial public offering in November of 2021 was so hyped was the EV maker's relationship with Amazon. Rivian had an offer for 100,000 units of electric delivery vans from the e-commerce giant, which it expected would bring in a significant portion of its revenue in the near term. So when Amazon struck a deal with Stellantis in January to purchase its battery EVs in 2023, investors in Rivian started to feel nervous. In the days that followed, investors realized Rivian had more serious problems to deal with, topmost being supply and cost constraints that forced the company to hike the prices of its EVs before it could start producing a meaningful number of vehicles. The move backfired, and after backlash on social media, Rivian rolled back its decision to seek higher prices from customers who had already pre-booked its EVs. Rivian's reputation and its stock price, however, got knocked out. This next part is very important. The biggest blow, though, came in March when Rivian didn't just report unexpectedly big loss of $2.5 billion for its fourth quarter against a revenue of only $54 million, but also said its parts and supplies would be enough to produce just 25,000 vehicles in 2022 between all its EVs. Analysts expected Rivian to produce 40,000 vehicles, and the company itself said it could have produced nearly 50,000 vehicles had it not been for supply chain hurdles. So Rivian got a bunch of investment money, and then basically the first thing they did with all of this investment money was lose any future sales with Amazon by tanking that relationship somehow, absolutely destroy their reputation online by trying to charge people more than the amount that they had originally agreed to purchase the vehicles for, and then miss production targets by almost 40% just in their second year of being a public company. But don't leave now, there is more. The hits just kept on hitting. Now this is from May 9th of 2022, so just a few months later. Rivian stock price fell by more than 17% on Monday, a drop prompted by a CNBC report that Ford was selling 8 million shares of the EV automaker. Ford held a 12% stake, or about 102 million shares of Rivian. Over the weekend, Dave Faber of CNBC said that Ford would sell 8 million of its Rivian shares through Goldman Sachs. Faber followed up on Monday, describing the sale as done. The sell-off came as an insider lockup for the stock expired on Sunday. An insider lockup for the stock basically just means that employees, founders, and early investors who bought into the company early on were now legally allowed to sell their stock. Usually there's an amount of time where they're not allowed to sell their stock for, and then on Sunday, May 9th, that expired, which usually leads to stock prices of companies to go down because employees who had been given stock or founders who had stock but weren't allowed to sell it off probably saw how badly the share price was doing, and so they tried to sell off basically as soon as they had an opportunity. And this, of course, caused the stock price to drop. But don't go away now. There is even more. This is from February 28th, 2023, so just a years ago. Shares dropped 8% as shareholders focused on a trio of suboptimal news, including missed expectations, a recall, and an increased but lower than expected production forecast for 2023. The company reported a net loss of $1.72 billion in the fourth quarter and $6.8 billion for the full year. On an adjusted basis, it reported a loss of $1.5 billion and $5.2 billion for Q4 and full year, respectively. And Rivian has been around since 2009, with the first prototype being built in 2011. So if they haven't been able to figure this out in the 12 years they've been around, it's understandable that investors might not think they're ever going to be able to figure it out, and as such, they're bailing. But at this point, we start to see that it's not just Rivian that's struggling, it's a lot of electric automakers. We see this is October 5th, 2023, so much more recently. Rivian stock drops 20%, Lucid down over 8%. Lucid Air is a different company that makes luxury electric vehicles, and it's much more like Tesla than Rivian is. A trio of electric vehicle stocks, Rivian Automotive, Lucid Group, and VinFast Auto, were making moves in afternoon trading. Rivian shares were sliding by 20% after the company offered disappointing guidance and announced plans to raise more funds. Lucid Air stock was down 8.5% after the company unveiled a new, cheaper version of its luxury Air sedan, which indicates investors are seeing the new version as a sign of weakening demand or a price cut. And finally, VinFast was down 2.4% after reporting third quarter delivery numbers that rose from the prior quarter. And even though VinFast saw their stocks go up in this report, they only went up by a very small amount. Usually when a newer company like this beats out their projections, they jump pretty significantly as lots of people want to get in on what they see as the ground floor to hope that future investments make a lot of money. So the fact that it only rose 2.4% is very telling. So essentially, Rivian constantly overpromised, underdelivered, and self-sabotaged their way into one of the biggest stock market flops that I can remember, with their stocks being down a grand total of 92% from their initial public offering in November of 2021. Now, it's not 100% entirely their fault because the entire EV market is struggling right now, and that is for three main reasons. They are price, trust, and practicality. Electric cars are just more expensive, and not only are the cars themselves more expensive, but then you have to do things like figure out how you're going to charge it. Are you going to install charging in your house, or are you going to have to drive out of your way constantly to find a charger near you? And then if you ever need any maintenance on the car, that is way more expensive because you have to probably take it to the dealership, as there aren't a lot of local mechanics who will be able to work on new fancy electric cars. And they also just tend to be less reliable, with pieces breaking or parts of the engine failing, and as such they are more expensive to own and maintain. And that leads most people to just not want to bother. It's a lot of money for a lot of inconvenience. The second factor is trust. A lot of people don't trust the reliability of electric vehicles, but also a lot of people don't trust the companies behind them. Basically, all electric vehicles are connected to the internet, and there's a fear that manufacturers will start locking features behind subscriptions and people will lose functionalities in their car after they had already bought. And practicality, we've kind of addressed in the other two. You need to be able to find a mechanic that knows how to work on those cars. You need to set up charging station. Road trips are essentially impossible because it takes hours to charge these cars, and they've only got ranges of maybe 200 to 300 miles. So with budgets getting tighter for middle or lower classes who buy up a lot of the cars, it's less likely that they're going to want to purchase an EV, and that essentially brings the entire industry down with it. But in addition to that, Rivian has also had a lot of unfortunate management decisions and lofty promises that they simply could not live up to, and that ultimately is what's leading to the layoffs. Thanks for watching.